Hey guys, what is happening and welcome to this video. So in today's video, we are talking about the Big Short. This is the second Big Short, something that was actually at the end of the Big Short, the movie. We're going to discuss how that has blown up into something massive that once again can take down the global financial system. So without further ado, guys, let's do this. Alright guys, welcome back. As you know guys, please hit that like button. It helps support the channel. It also helps get the videos to more people, and people need to hear this. So basically, obviously there was all these things called CDOs back in 2008, and it was one of the reasons that the financial system imploded across the globe. And the reason was because so much money was betting on mortgage-backed securities and the outcome, whether people would default or not default. And basically, at the end of The Big Short, the movie, actually a thing that said, now there is this thing called bespoke tranche opportunities that people are saying are like CDOs. This came to my attention actually in 2018 when I saw some articles saying that CDOs are back. One was in Bloomberg. And then in 2019, there was an article that was saying how these things are structured and how these things are different. Have we ever heard it this time before, guys, where they say it's different this time? And that's exactly what they said. They said it's different this time. There's going to be absolutely no problem with these new type of CDOs. But fast forward to right now, guys, and you have this thing that has turned into an atomic bomb. Hundreds of billions of dollars have gone into these synthetic CDOs over 2020, 2019, 2018, and it is creating an atomic bomb within the financial system. So what are these CDOs? Well, essentially they're like side bets on the outcome of bonds and different things like that. So they're not doing it on mortgage-backed securities anymore. They thought, you know what, something that is really, really secure, something that can never go wrong is the corporate debt market. So basically what they did was they said, hey, we're going to go bet on corporate debt, the outcome of whether a company defaults or can make payments on their corporate debt. And the bank said, yeah, we're going to take those bets because what are the chances of these companies going bad? Like, there is very little chance. So the bond market has been so secure for years and years and years. And fast forward to 2022, the bond market has imploded. It continues to implode right now. Yields are soaring. And that is a bad, bad situation because all these side bets that people took, which were hundreds of billions of dollars, just betting on the outcome of these bonds and corporate defaults, are now likely to happen. That means that corporations are going to be defaulting, and that means that those banks who were so willing to take all those bets because they thought, hey, you know, the probability of companies en masse defaulting is very, very low. But fast forward to right now, guys, we have extremely high interest rates compared to the past interest rates that we haven't seen since before 2008. And it is definitely making a massive problem in the bond market. The problem is a lot of these companies have thrived even throughout 2020 on the fact that debt was so cheap. Another problem was the fact that corporations, they wanted to make yields, so did pension funds. These pension funds are always after a yield. So what do? They think, well, you know what, maybe there's one thing that's going to make a return is let's bet on the outcome of, say, T-Mobile, whether they're going to default on one of these bonds. And the bank would say, yeah, we'll take that bet. You have to pay us a maintenance for it. And that's essentially what happened. So the banks were willing to take that bet because they knew the probability of them defaulting is very, very low. But as I said, fast forward to right now, the tables have completely turned. The chances of these companies defaulting has skyrocketed, especially on the more risky side. And the way it works is they separate these companies into tranches. Tranches are essentially a slice of something. So you can get a slice of the high risk debt, make a bet on whether there's going to be defaults in that debt, and it pays off very, very high payoffs if they actually default. Now, obviously, the payoffs are lower if the company is more likely to default, and the payoffs are higher on companies that are less likely to default. But now, there are so many companies, big companies, that are likely to even go bankrupt. Tech companies, large tech companies that are going to struggle to get funding, to get capital, because the environment that we're in, the commodity super cycle that I believe we've just entered, means that little do people know that these tech and hype stocks, they are over for now as a good investment. And that's not financial advice, that's just my opinion on what is happening right now. So the thing is, guys, the tables have turned and everything has changed, but the banks, they did not know that this was going to happen, and this has put them in an incredibly precarious place once again, where they have all these CDOs that are out there, all these CDOs created on CDOs created on CDOs, hundreds of billions, if not trillions of dollars out there betting on what's going to happen with these corporate defaults. And the banks, like I said, they were willing to accept those bets because the chances of them defaulting, like in 2020, were extremely low. But the probabilities have gone up right now. So I can assure you the chance, the opportunity cost to buy a CDO right now has probably skyrocketed. Like, it's probably not worth it to buy because the chance of default has also skyrocketed. So anyway, guys, it's an incredibly interesting topic, an interesting thing to talk about, I think, because this is exactly what was said at the end of the Big Short. And people think, this time it's different, it's not going to happen, they've put all these safeguards in place. But there is still very much a big thing under the underbelly of the financial system, which is called shadow banking. All these transactions that go on between banks that are in the shadows, that all these regulators can't even pick up on, they don't even know what's happening. And the regulators are always asleep. They're always regulating after something happens, not when something happens. So anyway, guys, I hope you enjoyed this video. If you did, please hit that like button. It's much appreciated. It helps support the channel. And if you enjoy content like this, then consider subscribing to the channel if you like this. But anyway, I'll see you in the next one. Peace, guys.